Welcome to today's Explainer. We're jumping right in because we've got a stock that, at least on the surface, looks like the absolute ultimate high-yield value play. We're talking about Annaly Capital Management, ticker symbol NLY. Now, if you're an income-seeking investor, you've undoubtedly seen this name flash across your screen at some point. But, we aren't just going to look at the flashy numbers today. We're putting this company through the absolute ringer to see if it actually holds up.
Okay, let's dive into this. A 13.24% yield. I mean, that is the kind of number that instantly makes you sit up in your chair, right? It pays out a massive $3 per share annually. But the really vital question we have to answer today is whether this incredible yield is a durable income stream or if it's hiding a massive wealth-destroying trap just waiting to be sprung.
I really want to emphasize this massive number right out of the gate, 13.24%. In a world where your standard bonds might pay you, maybe 4%, and a traditional savings account sits around 1.5%, a yield this high acts as the ultimate bait. It's literally one of the absolute highest yields you can find anywhere near the S&P 500, and it draws income investors in like a magnet.
So here's our gauntlet for today. 1. The high-yield bait. 2. Uncovering the red flags. 3. The undeniable green flags. 4. The guru face-off. 5. Does a moat exist? And finally, 6. The final verdict.
Section 1. The high-yield bait, the surface-level allure. Now, to understand the bait, you really have to understand the business. Annaly is a mortgage REIT, or real estate investment trust. Actually, they're the largest one in America. But here's the thing, they don't build houses. Instead, they borrow money on a short-term basis and use those exact funds to buy long-term mortgage-backed securities. Their entire business model, their absolute lifeblood, relies entirely on making a profit on the interest rate spread between what they earn on their assets and what they pay to borrow.
And this brilliantly illustrates exactly why investors have been swarming this stock, pushing it to a crazy 27.7% rally over the past year. The metrics are just staggering. You've got that 13.24% dividend yield, a price-to-earnings or PE ratio of just 5.5 times, which is a massive 65 to 75% discount to the broader market average, a price-to-book ratio of 1.13, meaning you're buying it for barely more than its liquidated asset value, and a return on equity of 19.6%. I mean, that sails right past Warren Buffett's famous 15% threshold. On paper, it looks absolutely perfect, doesn't it?
Section 2. Uncovering the red flags, looking past the surface.
Well, we have to start with the absolute elephant in the room here. 7.2x. That is Annaly's debt-to-equity ratio. For every single dollar of equity, they have $7.20 of debt. To put that into perspective, most legendary value investors demand a ratio under 1.0. Annaly is over 7 times more leveraged than traditional safety frameworks allow. It's kind of like trying to buy a massive mansion using a giant stack of maxed-out credit cards. Sure, in a smooth economy, leverage completely pumps up your returns. But in a crisis, this exact kind of leverage is what completely wiped out mortgage REITs back in 2008.
And the deeper we look into the fundamentals, the more brutal it actually gets. Earnings per share shrinking by nearly 18% per year. Return on invested capital is a measly 2.6%, which is way below that standard 15% safety threshold. The gross margin is virtually non-existent at just 1.0%, a far cry from a healthy 40% target. Free cash flow is actually negative, and they're diluting shareholders by issuing over 5% in new shares every single year. But the biggest so what here is that 94.7% payout ratio. They're paying out almost all of their earnings as dividends. Think about it. If they have even one bad quarter, that massive 13% dividend yield gets slashed instantly.
So when you run these fundamentals through rigorous quantitative value investing systems, the reality is incredibly stark. Benjamin Graham's framework gives it an F due to that high leverage. Peter Lynch's system, a D, thanks to negative growth and dilution. Warren Buffett's framework is just a straight-up fail. And the Guru Focus system scores it a brutal 4 out of 100, flashing 9 separate warning signals. Despite the massive high yield, the foundational health here is just severely lacking.
Section 3. The undeniable green flags, the bull case for Annaly.
Let's move to the data and see how this builds, because, to be truly objective, we absolutely have to acknowledge the very real, undeniably strong counter-arguments. The bulls aren't just making things up, they have hard data on their side. Alongside that juicy $3 per year payout, the deeply discounted 5.5 PE ratio, and a highly leveraged return on equity of 19.6%, they can point to some explosive recent growth. In Q2 of 2026, revenue hit $893 million. That is an astonishing 705% year-over-year increase. It shows they're actively capitalizing on the current interest rate environment.
Plus, their book value per share actually grew by 4.2% year over year to $19.82. And for a mortgage REIT, growing book value is a phenomenally healthy sign.
And the professionals completely agree. About 86% of the company is owned by institutional players. They deeply believe in this income stream. Wall Street analysts from major firms like JP Morgan, KBW, and Wells Fargo give it a consensus buy rating with a target of $24.33. Plus, with a beta of 0.85, which is a metric measuring a stock's volatility against the overall market, it actually trades with less turbulence than the broader S&P 500.
Section 4, the Guru Face-Off. Titans enter the ring. First up is the father of value investing himself, Benjamin Graham. Now, while Graham would absolutely love the incredibly cheap PE ratio of 5.5 and the low price to book, his entire philosophy hinges on having a margin of safety. And when he sees debt to equity sitting at 7.2x alongside completely unstable earnings over the last 5 years, well, that margin of safety vanishes entirely. Extreme leverage completely ruins the cheap price tag for him. Next, we have Peter Lynch, the master of growth at a reasonable price. Lynch's golden rule is that a company's PE ratio should equal its growth rate. But Annaly's earnings per share have been shrinking by 17.8% a year. You literally can't even calculate a price earnings to growth or PEG ratio when the growth is negative. Add in the 5% annual share dilution and negative free cash flow, and yeah, this is a disastrous fit for his strategy. He's out. Finally, Warren Buffett. So, the crucial point is that Buffett demands high quality and total pricing power. While he might initially like that 19.6% return on equity, he knows that's just an illusion pumped up by the massive debt. When he looks at the actual return on invested capital, it's a dismal 2.6%. And a gross margin of just 1.0% reveals that Annaly has absolutely zero pricing power. For Buffett, it's a complete pass. Section 5. Does a moat exist? The ultimate debate. There is a massive contradiction here. On one hand, systems like Guru Focus award Annaly a narrow moat rating of 5 out of 10, pointing to their massive scale, diversified portfolio, and risk management in mortgage-backed securities. But then, you hit the quantitative reality. A 2.6% return on invested capital, a 1% gross margin. The brutal math simply does not support the idea of a moat. A highly leveraged spread business generating single-digit returns on its capital simply does not have a true, durable competitive advantage.
Section 6. The final verdict. Income tool or value trap.
If you're considering the stock, you must ask yourself these checklist questions. Can that 13.24% yield actually survive when interest rates shift? Will that massive 94.7% payout ratio force a cut the second earnings dip? Is that 7.2x leverage manageable in a crisis? The conclusion here is clear. Annaly is unequivocally a value trap if you're a Graham, Lynch, or Buffett-style investor seeking safety, growth, or quality. However, for those who deeply understand the risks, it can act as a tactical income tool for a small portion of a portfolio, especially with their next earnings coming up on October 28, 2026, which is definitely going to serve as a major catalyst. Which leaves us with this final thought. It's the ultimate balancing act of the stock market. I want you to weigh the incredible reward of a $3 per year payout against the extreme principal risk of carrying 7.2 times more debt than equity. Let me know your thoughts down below. Is Annaly's 13.24% yield actually worth the risk? Thank you so much for joining me on this explainer. Keep analyzing, and I'll catch you in the next one.